Hi, everybody. It's Peter Schiff. This is Wednesday, September 21st, 2011. Well, Operation Twist is officially underway. Of course, though, it was more Operation Thud on Wall Street as the Dow dropped about 280 points shortly after the Federal Reserve announced its latest vain attempt to artificially stimulate the economy. You know, maybe some people were a little disappointed that we didn't get even more easing QE3 on top of Operation Twist. Although the real problem with Operation Twist is it's going to put the squeeze on the banks, which is not going to help the economy grow by any means. I mean, I guess what the Fed's idea here behind Operation Twist, and if you don't know what this is, what it means is the Fed is going to sell about $400 billion, dollars worth of shorter-term notes that it has in its portfolio. These are notes with 1 to 3 year maturities, and then it's going to turn around and buy government bonds or mortgages or whatever with 6 to 30 year maturities. So the Fed is going to twist its balance sheet in that it's going to lengthen the maturity of the government debt that it owns. Now, of course, long term, this puts the Fed in a more vulnerable position because when rates ultimately rise, then the Fed takes a bigger hit on these assets. And if the Fed has to shrink its balance sheet or tries to shrink it to tighten monetary policy and finally fight off inflation instead of create it, it's going to be that much more difficult because now it's got to sell long-term bonds into the market, which is going to put a lot of upward pressure on interest rates and unravel, reverse rather, any gain that the Fed thinks it's creating by bringing rates down. So I think it puts the Fed into a bigger box and makes it more difficult to shrink its balance sheet and makes it more painful for the economy when it ultimately does. But again, the Fed doesn't care about how much damage it does in the long run. The Fed is acting very politically, and it's trying whatever it can to try to goose the economy ahead of the 2012 election. So its latest brainstorm is that it's concluded that the problem with the U.S. economy is that interest rates, long-term interest rates, are just not low enough. I mean, despite the fact that they've never been this low in our lifetimes. I mean, the yield on the 10-year, I'm looking at it now, is 1.875. That's it. 1.875. The 30-year is down to 3.039. I mean, almost 3% even. We've never had interest rates so low. The economy is a mess. Interest rates are as low as they've ever been. And the Fed's conclusion is if we could just get them a little lower, that's going to do the trick, and the economy is going to turn around. You know, maybe one of the reasons the economy is in so much trouble is because interest rates are already too low. Maybe low interest rates are not part of the solution. Maybe they're part of the problem. That makes a lot more sense to me. And if low interest rates are part of the problem, then making them even lower makes the problem even bigger. You know, it's kind of like somebody's on a diet and they're convinced it's going to work. And the diet consists of just eating Twinkies. And so the person is eating all these Twinkies, yet they keep gaining weight. And they're not sure what the problem is. And they come to the conclusion that, if I just ate more Twinkies, maybe I'd lose some weight. And so they just scarf down even more and they get fatter. And it doesn't occur to them that the reason they're so fat is because they're eating all these Twinkies. And what they've got to do is stop eating them. And again, it's not occurring to the Fed that it already has interest rates at rock bottom levels. It's kept them there for years, and yet the economy is in worse shape as a result, not better shape. And just bringing them down slightly isn't going to work. But this is the Fed's thinking. Again, the Fed is thinking, well, gee, we got a lot of people that have mortgages. If they can only refinance them at a lower rate, then they'll have some extra money to buy more stuff. And that spending is going to spur the economy. Well, first of all, no, it's not. I mean, most people, yes, it's certainly going to help the typical family if they can reduce their mortgage payments. Of course, for those families that are still making mortgage payments, there are a number of people that just stop making payments altogether. And so for them, it really doesn't matter what the mortgage rate is. But the majority of Americans are still paying their mortgage. And yes, if they can refinance and save $50 a month or $100 a month, yes, they're going to spend a little bit more money on food, on gasoline, but I mean, that's not going to help the economy because we spent more money. I'm not saying that It's not going to help out for people to have a little extra money, especially when they're drowning as it is. Yeah, you're throwing them a little bit of a lifeline, but it's not going to change the dynamics because that's not going to grow the economy. I mean, more consumer spending isn't going to change anything. Consumers are already spending too much, and just enabling them to spend a little more isn't going to change the dynamic. It's not going to grow the economy. It's not going to create jobs. But what people have to consider is, where's the money coming from? If mortgage borrowers are going to get a little bit more money because their payments are down, where's the money coming from? Who is on the losing side of that transaction? And it's the lenders, because the lenders now are going to collect less in payments on the mortgages that they hold. And so that puts the squeeze on the banks. Now, in the past, as long-term rates were falling, so were short-term rates. In fact, short-term rates were falling even more. You had this positive sloping yield curve, and so the banks were able to handle the refis, because even though they were giving their borrowers a better deal, they were getting a better deal themselves, and so they still had a positive spread, and so they weren't really being hurt by all the refinancing. But at this point, short-term rates can't go any lower. In fact, yields on 1 to 3 year maturities are probably headed a little higher now as a result of the twist. And so all this mortgage refinancing that the Fed is hoping to engineer comes at the direct expense of the banks. The gain to the borrower is the pain to the lender. And that is one of the reasons that you look at the banks today all hitting new 52-week lows. Look at Goldman Sachs, Morgan Stanley, JP Morgan. These stocks are getting crushed. In fact, it looks like they're going for the 2008 financial crisis lows. And of course, everybody in Congress seems to agree that small businesses need access to credit. They need to be able to borrow more money. And the idea is, well, let's lower interest rates. But lowering interest rates on home mortgages is actually going to make it harder for businesses to borrow money. After all, if the banks are getting squeezed, if their assets are losing value, if they're collecting less on their mortgages, they have less capital, they have less income to loan to small businesses to expand or to hire. All we're doing is shifting credit away from businesses back to consumers so it can be spent. So in other words, this plan is going to backfire on the Federal Reserve. It's going to actually restrict credit where we need it, and yes, it's going to allow for greater consumption, but that's the last thing we need. And of course, I think what the government is also trying to do is, a lot of people can't refinance and take advantage of these low rates because their homes have lost so much value that their current mortgage exceeds the value of their house. And I've read that the Treasury or Congress is going to try to put pressure, or the Obama administration put pressure on Fannie and Freddie to guarantee mortgage refinancings up to 125% of the value of the home, which would let people who have been unable to refinance in the past because they had no equity refinance now, despite the fact that they're already underwater. And of course, this is even going to further endanger the banks because now you've got a bigger problem, because the banks, on the mortgages that they were still collecting, right? Because there are a lot of mortgages that are in default where the banks are getting nothing. But at least they've got some mortgages where the homeowner is still paying, and so the money they're earning on the performing mortgages is offsetting some of the losses on the non-performing ones. But now, if all these people who have not been able to refinance but who have been paying, if all of a sudden they get a big refinance at a much lower rate, that really clobbers the banks. And so what's going to happen? What the government gives with the right hand, it's going to take away with the left hand, because if the government bankrupts the banks again by putting a squeeze on them, where's the money going to come to bail them out? And then, of course, what about the effects on pensions, on insurance companies that own these assets? They're going to see their yields going down. What are they going to do? How are they going to make up for the losses? Are they going to raise insurance premiums for their customers? So, whatever, maybe you gain a little bit because your mortgage payments go down, but now your insurance rates go up. And what about all the people, of course, that are living off of income, not just the banks, but what about people that are living off of fixed income? They're going to have less spending. So none of this is going to work. These are all gimmicks. But while the Fed is, rearranging the deck chairs on the Titanic of an economy, the real fundamental imbalances are allowed to get bigger and bigger and bigger, and nothing is being done about it. Nobody is questioning the legitimacy of a strategy that has repeatedly failed. Again, it is that old definition of insanity to just repeat the same thing over and over and over again and expect a different result. We're not going to get a different result. We're going to have the same results. If we want a different result, we've got to change the strategy. But unfortunately, there is no political will to change the strategy, because that involves leveling with the public, letting the public know how screwed up the economy is, how it got this way. It got this way because of government, because of the Federal Reserve, because of cheap money, because of excess government spending, excess government regulating, excess government taxing, and meddling in the economy. And that the solutions to the problems are going to involve a lot of short-term pain as we get all this government heroin out of our system, but that it will work, but that the solutions come from us. They come from the free market. They don't come as a gift from government, because government has nothing to give. It can only give what it takes. But the problem is it costs so much money to keep the government going, it always has to take away a lot more than it gives. And in the process, it so screws up the economy with malinvestments and bad incentives that it diminishes the standard of living of everybody. Anyway, we'll see how the market continues to react as we move later in the week to this announcement. Of course, I will be talking about this in depth on my radio show, as I do every day. And so if you're wanting more of these video blogs, the best thing to do is just tune in to shiftradio.com. I'm doing that show live every day for 2 hours. From 10 a.m. to noon Eastern time. And if you can't listen to it live, you can always listen to it delayed. Anyway, that's it for today. Take care, everybody.